I'm Grant Walker. Welcome to Last Call for Monday the 22nd of June. I'll be back with Heads Up Tuesday morning, 10 a.m. To crowdfunding. A number of companies have won FMA certification to host a crowdfunded equity platform, but the two making all the running are Snowball and PledgeMe. How are startups choosing which platform to run with? Puna Kaiki Fund has a already successful raise underway on Snowball. So what made it plump for that platform? Puna Kaiki principal Lance Wigg says we ran a process between Snowball and PledgeMe and found it difficult to choose between them. Snowball won because of its track record to date, the fact it was preferred by our existing investors, and because we were able to offer the same net brokerage rate to all investors. New Zealand being a small town, it also comes down to who you know and how they impress you. And so it was, as another successful crowdfunding equity candidate, craft brewer Yeasty Boys, threw in its lot with PledgeMe. Yeasty Boys director Stu McKinley says, I was introduced to PledgeMe boss Anna Gunther soon after we started to think about raising capital, and her business ethic resonated with me absolutely. He said she's the type of person who brings good people together to do great work, and this is the kind of thing we do in all aspects of our business too. We like to think of ourselves as leaders in the craft beer world, and Anna most certainly is the leader of New Zealand's crowdfunding community. There was never a question of whether or not we should use someone else. NBR's stocktake earlier this month found Snowball, which has raised $6.2 million, has had a 100% success rate since launching its first campaign for Renaissance Brewing last August. Green Coke producer Carbonscape, Lee Tamahori film The Patriarch, drone maker Aeronavix, wine company Invivo, and cystic fibrosis drug developer Breathe Easy have all successfully raised funds on the site. Since then, Puna Kaiki's raise has got underway, easily eclipsing its minimum target of $200,000. PledgeMe, which has raised $1.6 million, has had a 66% success rate, running successful campaigns for itself, craft brewer Yeasty Boys, rideshare app maker Chariot, Trade Me competitor Cell Shed, children's shampoo maker Pineapple Heads, and app maker Parent Interviews. Campaigns for hovercraft operator H2 Explore, computer museum Techvana, and youth well-being site Be Internet Youth failed to attract enough investor support. New Zealand's third equity crowdfunding platform, Equitize, has kept a lower profile than the other two after getting its licence last December. It's run two successful campaigns, raising $666,300 for tourist in-car guide Tourism Radio NZ and annuities provider Retirement Income Group. To Mexican sheep. An honorary professor of agri-food at Lincoln University says he expects the majority of the 50,000 sheep exported 2 weeks ago for a breeding program to be slaughtered within months of arrival in Mexico. Since the moratorium was imposed in 2003 and the customs export prohibition order in 2007, livestock cannot be exported for slaughter. In the largest shipment of live sheep since 2003, the Nada departed Timaru 2 weeks ago with 50,000 sheep and 3,000 cattle, after hundreds of sheep bound for the shipment died while in quarantine in the final days before embarkation. Professor Keith Woodford says of the young sheep, most of which are about 10 months old, the prima facie evidence would seem to be that the Ministry for Primary Industries has been fooled by the fact these animals are mated. Questions have to be asked as to whether this mating has largely been a charade. The information I've been getting is that they've been mated to ram lambs of mixed provenance, and that a considerable number of the ewes are the result of what in New Zealand we call terminal crosses, that is, animals always destined for slaughter. The likelihood is that only a modest percentage will be pregnant. Professor Woodford says, my expectation is that within a few weeks and months the majority will have ended up being barbecued at local festivals. This would be consistent with what apparently happened to similar shipments in the past. At both state and federal level, the Mexican government has for several years planned to repopulate the national sheep and cattle herds, reduced by years of severe drought in the north of the country. According to MPI's Deputy Director General Scott Gallagher, several Mexican states have been identified as priorities for sheep repopulation. Mr. Gallagher says, as with all live animal exports, the exporter must sign a statutory declaration that, to the best of their knowledge, the animals are intended for breeding. This is a legal document. The MPI Deputy Director General says there are international standards on animal welfare, and Mexico is a member of the World Organization for Animal Health. Mr. Gallagher says it's important to note that it's in the importer's best interests that the prime breeding stock being exported remain in excellent condition so they can make a return on their investment. It would be uneconomical to import expensive breeding stock for slaughter. However, it appears that since the introduction of the Customs Export Prohibition Order in 2007, no MPI staff have ever travelled to the countries New Zealand livestock has been exported to ensure breeding stock have been bred from. Mr Gallagher says this is because once the animals arrive in the importing country and are unloaded, the importer becomes responsible for the animals. However, he says, if MPI ever became aware of any information that indicated any exported animals were not being treated in line with our expectations, questions would be asked of the relevant parties, with a distinct possibility of consequences for such parties for any future proposed exports.
This is NBR Radio on Monday, June 22nd. I'm joined by Chris Hutching, who says that there's further evidence the government's central Christchurch rebuild blueprint is in tatters, Chris.
Yes, I think that we can say that after the earthquakes we really did need a new authority, perhaps something to inject some urgency into what had occurred because the central city was so damaged. And I think we must praise Sarah to begin with by saying that if there hadn't been this authority, there may have been a lot of buildings strewn throughout the central city that would possibly still be there. So setting up this authority with the ability to purchase land by the Crown was a good idea. So they've done that, largely. There are only a couple of demolitions to go, a handful. One of them is the most controversial. It was actually the first building to be built in Christchurch after the earthquakes. It's called the West End building, and it's a small two-level building in Manchester Street. But unfortunately or perhaps fortunately, because they have now been bought out, the owners of this building, as I say, were the first to get this building up and running after the worst February 22 earthquake. Now that's going to have to go. Sarah's going to destroy this building because it's got plans for that stretch of Manchester Street. It wants to widen it, turn it into a boulevard. And on one side we have the central city, which is being rebuilt largely by the private sector. On the other side of this building we have a thing called the Green Frame, which is basically just a whole lot of land which the Crown has purchased in order to turn it into essentially a green frame, a park. So they're going to take off this building. People will be able to stroll down this boulevard. On one side they'll see the rebuilding of Christchurch, and on the other side they'll see a great big green swathe extending to nowhere. So getting back to the point, Sarah's blueprint in tatters, yes, Sarah was very good at doing this initial work of clearing the place away, but they've proved spectacularly unsuccessful in driving through developments that are put out by the Crown. Tendering takes place usually, and I'd say that at the moment we can count on about 3 buildings that are going up that have got anything to do with the Crown, and they'd be mainly to do with emergency and justice precinct buildings which are being rebuilt to replace ones that were lost.
And you've pointed out, Chris, of course, that the government's been stonewalling in terms of explaining what's going on, but we have had an admission from Jerry Brownlee that the convention centre is at least 3 years away now.
That's correct, and that's really what's brought things to a bit of a head, with a number of articles coming out about hints that Jerry Brownlee and the Prime Minister John Key put out in recent couple of weeks that they might be rethinking the whole plan. Now, I've got to say that there are a lot of people here that don't think that a convention centre is going to be the answer to all our ills. However, the business community is very keen to see this go ahead so that we get numbers of people from outside pumping through. And the people that put on these convention centres, or at least the council people that do, under a subsidiary called V-Base, claim that they've already got a convention lined up. And they need a convention centre, of course. We do have some venues where people hold conventions, so it's not a completely convention-less city. However, it is a symbol. It's a symbol of a major part of the rebuilding, and we don't know when this is going to happen. It also involves a couple of other anchor projects. There's a Metro Sports facility near the hospital, which is also now in doubt. So people are just beginning to wonder, look, how serious is this government about putting in place the promises that it unveiled in mid-2012 with great hoopla. It was a great big bash in town. All the media were invited. It was put on in time for the TV news. Well, it's all looking a bit hollow now.
And as you say in the article on the NBR website, I mean, while the private sector's, steaming ahead, the Sierra-controlled areas look something like a wasteland. And, of course, now, I mean, Sierra, its role is being questioned and its relevance is being questioned.
Yes, Sierra is apparently going through a transition, and we're waiting for as usual, a report on this. And at the moment, Sierra appears to be under the direct control of the Cabinet, the Prime Minister's office. What this means, we don't really know. Sierra doesn't really tell us anything about what it's doing. People observe things happening, ring them up and ask them. Sometimes they'll tell you, sometimes they won't. It's a pretty appalling PR situation, if you ask me. I think, though, I'd have to leave on the message that things are not dismal and hopeless down here. The private sector is going gangbusters. And this is the curiosity where you see such a juxtaposition between a government bureaucracy as opposed to what the private sector is achieving. And it's quite incredible, really. The Central Business District has simply jumped across the Avon River to the west along Durham Street, Cambridge Terrace, Victoria Street. That is now the new Central Business District. And it also extends down Cashel Mall, where there's an awful lot of building going on there, office, retail, and that'll be ready probably in the next 18 months or so. And I think we're really going to see numbers surging back into the centre of town around about that time. But as far as the government sector side of things go, it seems to be broken promises and incompetence.
My thanks to Chris Hutching.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. VNC Cocktails offers 3 cents in the dollar. Air New Zealand sells Safe Air Engineering. Consumer confidence drops. Migration figures continue to hit new highs as those going to Australia the smallest since 1992. Dunedin Clean Tech reaches crowdfunding goal and A2 Milk is a takeover target. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio.
This is NBR Radio on Monday, June 22nd. I'm Owen Poland and welcome to the political and economic week ahead with Neville Gibson, who's filling in for Rob Hosking. And Neville, the New Zealand dollar under more pressure this morning. What's driving the currency down?
It certainly is. The dollar's getting all the headlines and it's down to 60.5 euros, which is a 15-month low against the European common currency. And the main reason for this fall, of course, is Greece. It's been at the top of the international agenda now for some time, and we've had some urgent talks over the weekend with the left-wing government there preparing new proposals for how it's going to pay back that 1.6 billion euro loan from the IMF. The Prime Minister, Alexis Tsipras, is scheduled to meet the country's key lenders sometime today or tomorrow. And then there's a big meeting of all the Eurozone nations. So this is a continuing thing. I hesitate to call it a crisis, but it's certainly dominating the world currency trading at the moment.
And of course the Kiwi dollar is in fact down really across the board against all our major trading partners, Australia, the UK, the US, and even China to perhaps a lesser extent.
That's right. That's because the New Zealand dollar is one of those currencies that's on the fringe of the major ones, and whenever there's some crisis or volatility in the market, everyone heads for the yen and the US dollar, and that obviously drains support away from the Kiwi.
On the political front, there was a lot of talk over the weekend about a party that isn't even in Parliament. Does anyone, apart from the tittle-tattle, does anyone actually care about Colin Craig and the Conservative Party?
Well, I did watch the TV programs at the weekend, and no, there's no real influence on the political scene from such a small party. I don't think the Cabinet's going to be worried about it. In fact, they've got a much bigger thing on their agenda. The more immediate one, of course, is the cost of flooding in Wanganui, Manawatu and Taranaki, as well as the possible impact of snowfalls in the South Island. I noticed that Civil Defence Minister Nikki Kay's already been down in Wanganui and Rangatiki, and it's amazing that the river there, where virtually the whole city is on both sides of the river. It's all right if you're up on the eastern side, you're up on top of a cliff, but it's been at the highest level ever since the last record in 1904. As for Colin Craig, well, he's a major source of money for the party, and it's unlikely to survive for long without him unless they can get some more of those major donors across. But there's no real succession plan for the leadership. And I think the Conservatives are largely a voice in the wilderness and likely to stay that way.
You're listening to the Political and Economic Week Ahead with Neville Gibson, and turning back to the economy, Neville, what's happening on the domestic front this week?
Well, one interesting thing that hasn't had a lot of press is the big change on the NZX. Its main index, the 50 gross index, is now going to be measured by Standard & Poor's and Dow Jones, so it's getting into line with what already happens in Australia and on Wall Street. So far it hasn't brought a lot of major change, but today the index will be calculated with Meridian Energy replacing Trade Me, and one of the casualties of it is Refining NZ. The methodology of calculating all that is a little bit beyond me and simple explanation on the radio, I'm afraid, but that'll be closely watched. The index fell 1.1% last week, so it's up 11.4% for the year, but it'll be interesting to see how the day closes out.
So we're joining the big wide world, the S&P NZX Top 50.
That's right, measured, and the gross index means that it includes the payout from dividends rather than just being a simple index.
Now, on the statistics front, what can we look forward to? I understand there's already been some announcements today.
Yeah, the major one, or there's two been out this morning. The most interesting one is Consumer Confidence Index for the latest quarter from Westpac McDermott Miller. It's now down at 113, and while this is above the historic average of 101.5, it's the lowest since March 2013. So that drop really doesn't come as much of a surprise. The bad news has been coming for some time now, and there's all kinds of headwinds, as they like to say, that business confidence is slowing down along with the consumer confidence. But it's not all bad news. I don't think consumers are rushing away from things, so they're likely to stay pretty steady, but they haven't exactly departed from the market, but it's still a less optimistic view than you'd like. The other statistic out this morning showed increased tourism flows from China, up 10% for May. And looking towards the end of the week, we've got the merchandise trade figures that are due out on Friday. They're likely to show another big impact from the dairy exports.
Obviously, the dairy sector is driving all of our thinking, probably in terms of consumer confidence and merchandise trade. And last week we had a yet another fall in the global dairy auction prices. So, I mean, that sector is just under continuing pressure, despite this optimism that it might pick up sometime next year.
Well, there doesn't seem to be any sign of a pickup. Those prices. One thing you can say about the dairy prices is that they seem to have hit a bit of a plateau, and the Chinese buying, which is one of the main drivers, they wait long enough for when they think prices aren't going to go much lower before they get really back into the market. The fall in the whole milk powder was the slightest of the two, and some of the other types of dairy products have shown an improvement. But as I say, they've plateaued out a bit. Let's hope they don't fall too much further, too much more quickly.
And of course, getting back to the currency, which I guess is the big talking point, it's a double-edged sword, isn't it? Because the falling Kiwi dollar is going to attract potentially more tourism from the likes of China, but of course it's going to have an impact on consumer spending domestically, isn't it? Because everything is going to suddenly get a bit more expensive.
It certainly will, although there are no signs of inflation taking off. The oil prices stayed pretty steady, around about $60 a barrel on the futures market. So I think inflation is being held pretty steady. But as you say, the income for farmers will be slightly greater with that, from the lower dairy price, because of the dollar is falling. So, but it does make imports, and it'd be probably noticeable, most particularly in Japanese cars and one or two of those big ticket items, as well as the oil price and the price
fuel.
of the pump is always,
it's going up.
Yes, it is. It's always
up.
a good indicator, and it's been pretty steady at just over $2 for 91 at the moment.
Thanks, Neville. That's the political and economic week ahead with Neville Gibson.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
I'm Grant Walker. Welcome to Last Call for Monday the 22nd of June. I'll be back with Heads Up Tuesday morning, 10 a.m. Leasing news. Blue chip corporates Deloitte and IAG New Zealand have signed up as anchor tenants in a new 14-storey Wellington office building going up on the old BP House site on Custom House Quay. BP House was damaged in the Seddon earthquake and is now being demolished. Wilton Capital owns the site and has entered into a joint venture with Auckland-based developer Newcrest to develop and then jointly own the 17,000 square metre 5-star green building designed by Studio Pacific Architecture. Resource consent has been granted for 20 Custom House Quay as the new office block will be known, and it will open its doors in September 2017. It has been designed with rectangular 1,280 square metre floor plates, 3 metre high ceilings, a side-hung core and relatively few interior columns. IAG is taking 3 levels in the new building and Deloitte is downsizing its work footprint to 2.5 floors. Newcrest Development Director Lincoln Fraser says the building is being engineered to far exceed the building code for seismic performance. Structural engineer Alistair Catanach of Wellington's Dunning Thornton Consultants says 20 Custom House Quay will incorporate base isolation and has been designed to prevent structural damage, which could disrupt business continuity in a 1 in 500-year earthquake. Deloitte Chief Executive Thomas Pepos, who is also a board member on Wellington Regional Economic Development Agency, says the new building is a confidence boost for the capital. To the US presidential race, a new poll shows major changes in support among 13 contenders for the Republican presidential nominations in the US. The Wall Street Journal NBC News poll among Republican primary voters was conducted from June 14 to 18 when several confirmed their candidacies. The voters were asked whether they could see themselves supporting any of the candidates. The biggest changes were in support for some of the second-tier contenders. Mick Huckabee, Ben Carson and Carly Fiorina all gained significant ground. Ms. Fiorina, a former chief executive of Hewlett-Packard, jumped 17% in the April poll to 31% in June. Mr. Carson, a former pediatric neurosurgeon, and Mr. Huckabee, a former Arkansas governor, increased 11 and 13 percentage points respectively. All three formally entered the race in early May, just after the April poll. Support for the 3 leading candidates, Jeb Bush, Scott Walker and Marco Rubio, largely held firm. Mr. Bush, a former Florida governor, edged upward, with those who said they were open to his candidacy rising to 75% in June from 70% in April and 49% in March. That puts him 1 point ahead of Mr. Rubio, a Florida senator, who was unchanged at 74% and up from 56% in March. Mr. Walker, the governor of Wisconsin, slipped slightly to 65%. Of the 3, only Mr. Walker hasn't yet declared his candidacy. His announcement is expected in mid-July. Property tycoon Donald Trump, who's the latest to confirm his candidacy, jumped 9 percentage points, as did former Texas Governor Rick Perry and former Pennsylvania Senator Rick Santorum. The bad news for Mr. Trump is that 2 out of 3 Republican primary voters say they won't consider voting him after his high-profile campaign launch. New Jersey Governor Chris Christie is also well off the pace with a 36% rating against Mr. Trump's 32%. Mr. Christie is expected to announce his plans in the next few weeks. Kentucky Senator Rand Paul had the biggest reversal in support, dropping to 49%, the same as his March rating, but down from 59% in April.
This is NBR Radio on Monday, June 22nd. I'm Owen Poland. Some of the companies listed on the NZX's alternative market, affected by a nearly 5-fold hike in annual listing fees, have vowed to fight the impost. Joining me with more on that story is NBR journalist Jenny Ruth. And Jenny, you've been speaking to some pretty grumpy company executives.
Yes. I think anyone will be upset if they got a near 5-fold increase in annual fees. And some of these companies are... They've got plenty of other battles to fight. One of the people complaining is Chris Castle, the managing director of Chatham Rock Phosphate. Now, a year ago, his company wouldn't have been affected because it had a much higher market capitalisation. But since then, it's lost its marine application consent to mine Chatham Rock off the coast of Canterbury, and its market value has just plummeted. It was worth 2.3 million at the end of last week.
Mm.
And it had been, it's been cutting every cost it can think of to keep the company alive while it considers what to do next. And to have this big increase in fees from the stock exchange is not what it needs.
Another company you spoke to, Enprise, had just, in fact, shifted from the Australian NSX market, where the fees were similar. Yeah.
They're a New Zealand-based company, and they thought they'd like to be based at home and let New Zealand investors have access to their story. And they looked at the costs, and at that time they moved, which is late last year, the costs were pretty comparable. And lo and behold, now they've made the move, now their costs are being hiked considerably. They're also, although they've got ambitions to grow, they're currently nowhere near big enough. Their market cap's 3.4 million. They don't qualify for the exchange's new market, NXT. You have to have at least 10 million market cap to qualify for that market.
And of course, Just Water, Tony Falkenstein has said that he just considers it an abuse of monopoly powers. But, I mean, what options...
He's not alone there too.
Yeah. What options do these companies have? I mean, they can delist, but how can they fight this? I mean, I understand he's having a meeting with the NZX this week.
He is having a meeting, and actually NZX, I think they've realised how unreasonable that demand appears. They gave them less than 2 weeks' notice of this change in fees. Now they're indicating that they're willing to be flexible, although they do emphasise it depends on each company's circumstances. Well, I would definitely be arguing that no company that faces competition could increase their fees to such an extent, and that it simply isn't reasonable.
Yes, now, I mean, what does the NZX mean by willing to be flexible? I mean, how can it have a differential scale of fees for companies in this one index?
Well, in a sense, it already has a differential fee scale because these companies were paying much less than anybody else. But then they're very tiny companies by comparison with most companies listed on NZX or NZAX or NXT, by that matter.
Well, it'll be very interesting to see whether is some flexibility in give and take once they've had a session and had their ears chewed by Tony Falkenstein, I guess.
Well, I don't think that he's likely to back down.
Indeed.
And yes, I would expect to hear from him whatever the outcome of his meeting is.
All right, thanks, Jenny. That's NBR journalist Jenny Ruth.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
This is NBR Radio on Monday, June 22nd. I'm Owen Poland, and welcome to our weekly edition of Market Talk Currencies with NBR's Jason Walls and Sheldon Slabbert, markets trader with CMC Markets. And Sheldon, let's start with a quick look at the overseas markets. What happened last week that was significant in your mind?
Well, the standout last week was certainly the massive sell-off we saw in the Chinese markets, giving back about 13% just on the week itself. Still strongly up for the year, but that sell-off is really catching a lot of pundits offside. Of course, the knock-on effect of a slowdown in China is well documented, both for the New Zealand and Australian market. In Europe, again, the battle between what the effects that Greece is currently having on the markets and the potential risks around that is seeing the equity markets edging around that 11,000 mark on the German DAX. The US has been quite a strong performer. It's a little bit down for the month to date, but for all the risk in the markets, it's been pretty steady. But again, like I said, the highlight for me is the Shanghai index being 13% down, and at the moment, just the futures prices this morning is again looking for a weaker opening this week.
Because we've seen the Chinese, they've been injecting a lot of stimulus into their economy this year. I mean, we've seen a couple of rate reductions. We've seen their reserve ratios declined as well, and I think there was something to do with their tax on some of their commodities decreasing as well. So, I mean, how do these two link?
Well, the amount of stimulus that they've actually put into into the markets is eye-watering.
It's huge, isn't it? It's massive.
To put that into context, right, is that from 2007 to 2014, they have increased their debt load from about 7 trillion to 28 trillion. So they've trillion US dollars, is not renminbi.
Yeah.
So it is absolutely eye-watering the amounts that they've stimulated the market. I think the biggest one of the issues they do face is that a lot of that stimulus and capital have gone to unproductive assets. So like for instance, bullet trains and all that sort of stuff with not enough passengers there to actually bring the return to repay the debt.
So they're just spending money just willy-nilly on these sort of things.
Yeah, look, they're probably looking, borrowing a little bit from the future, like many other economies are doing as well, but they're doing it at a great pace. Some of the run-up we've seen in the stock market is justified. I mean, there's been a rebalancing between Hong Kong and the mainland China, and funds being able to freely flow between mainland and Hong Kong now. Some of that restructuring justifies some of the equity prices, but not wanting to use the bubble word, but it's certainly it's
the B word. Yeah.
When you look
economists' swear word, isn't it?
Absolute parabolic rise in the stock market. I mean, it looks a little bit scary.
And of course, we have Greece again. Apparently there's an important meeting this week, and it's apparently the last chance to sort this problem out that's been going on forever.
Yeah, I mean, it's currently at about 1 o'clock in the morning or 12 o'clock in that time zone in the in Europe. But we've seen that Greece's Prime Minister Alex Tsipras just presented some reform proposals. So this happened just a matter of like an hour or so ago. So it was a literal 11th hour decision. So it's very interesting to see where this is going to be heading in the future. And I mean, Sheldon was just talking about it before, that the markets have already priced in all of these things. But something that I've been really interested in is what happens if the Greeks default on their bonds? Because that's the big one, isn't it?
Yeah, look... To me, in my personal opinion, I think the bondholders should have taken a haircut a long time ago. But there's so much invested by both the Germans and various other players in keeping Greece within the euro that my anticipation is that Greece will remain in the euro. And, there's, like you rightly pointed out there, all the various facets have already been looked at, perhaps a default, but still stay within the euro and so forth. I personally think we'll just extend and pretend again in Greece. There'll be some kind of reforms and some kind of bailout package put forward by the IMF, which will probably be the lender of last resort again.
You're listening to Market Talk Currency with NBR reporter Jason Walls and Sheldon Slabbert from CMC Markets. And looking closer to home, Fonterra under pressure. The dairy auction price is down again last week. There's talk about a restructuring and massive job cuts at the head office. What's the outlook for the agri sector, and how will this impact on the Kiwi dollar?
Well, it's looking a little bit grim, isn't it?
Yeah. Unfortunately, the dairy auctions, last week's dairy auction again, disappointed. We were looking for those prices to stabilise a bit, but it still hasn't. I suppose silver lining is that the level of the fall in the prices, at least that is stabilising a bit. But when you look across the sector, lamb prices, wool prices, also lumber, that's recovered well. Although, dairy is obviously dominant, but, across the sector itself, it's looking better. So it's not all doom and gloom. Look, we certainly see when we look at the milk futures, we hold up a little better hope for future auctions. Also, demand out of China. I mean, there's been some supply issues there as well, which is working in our favour. Look, I think that, if you look at where we've come from last year to where we are currently, I think we will see some stabilisation in dairy auctions going forward. So I don't think it's all doom and gloom.
Because just going back to that, what we're talking about with the stimulus in the Chinese market, I mean, that's more money in the pocket of the consumers. So essentially, Economics 101 would dictate that that's good for New Zealand and the price of the dairy would go up, or the powder?
Yeah, look, to a certain degree, you're right. And also I think that one thing is that once you've lifted your level of living, you don't necessarily want to go back. So, and I think the consumer demand is growing in China. And this is another reason why I think that although the Kiwi dollar has fallen quite strongly against the Australian dollar, one of the future outlooks or differences in outlook why I'm a little bit more optimistic on the Kiwi dollar is just that our focus to the Chinese market, ours are consumer-related agricultural supply, while obviously Australia is more industrial. So I think that will certainly play out in the currency markets. And as you rightly say, that all that stimulus flows down, eventually trickles down into the pockets, and so the consumer spending will be there,
And of course, last week the Kiwi came under more pressure with that weaker-than-expected GDP figure.
Yeah, it was a gut punch for the Kiwi.
0.2, right?
Yeah, and well off the 0.6.
Well off.
Expected.
Yeah, that's a big dip.
It's a major miss. Yeah. So, that's certainly set the alarm bells off. And ANZ has come out and they were the ones that were quite aggressive in their rate cut calls a couple of weeks ago. They were spot on. So we've seen the first cut, and we expect another cut in July for the next meeting next.
In July?
Yeah.
Okay.
Potentially,
that early?
Potentially as early as July.
Yeah.
And then pencil a third one in for later in the year.
A third one?
Yeah.
So we're going to dip
yes.
below the 3% mark by the end of the year?
Potentially, yes.
Wow. Okay.
I think we could breach it, yes.
What factors are we looking that are going to influence that? I mean, we've got the dairy auction, we've got the lower GDP numbers. Anything else?
Consumer confidence down this morning?
Yeah, consumer confidence, that is a big barometer, as you guys well know. I think the overall risk factors in the global economy is not just going to be, we sometimes focus too much just on the domestic side of the equation. We need to look at potential risk factors abroad as well. So although China, like we just covered now, the Chinese consumer will still be there, but I think the overall risk factors and the geopolitical factors, other things that we don't necessarily focus on a day-to-day basis, will come into play and affect risk appetite and investor sentiment, and something that the Reserve Bank themselves will take into consideration.
And that's this week's edition of Market Talk Currency. My thanks to NBR reporter Jason Walls and Sheldon Slabbert from CMC Market.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
In banking news, ASB Bank, the local subsidiary of Commonwealth Bank of Australia, has agreed to an independent review into the way it sold rural interest rate swaps and will adopt any recommendations if it's found to have fallen short. The Auckland-based lender reached a settlement with the FMA to call in a third party to review the sale, promotion and marketing of the swaps to some customers, though it doesn't accept it did anything wrong in its sale of the instruments. In December, ASB cut a deal with the Commerce Commission over the sale of the swaps, agreeing to make $2.7 million available to compensate the 40 eligible customers who registered their complaints with the Commission, pay $250,000 toward the Commission's investigation costs, and a further $250,000 to the Dairy Women's Network. The FMA said it had concerns stemming from the Commission's investigation over the way ASB marketed and sold the swaps, but didn't carry out a separate probe into the lender. Today's settlement will see ASB hire a third party acceptable to both the bank and the FMA to review and report on whether the lender has processes and procedures to minimise the risk of making misleading statements when selling interest rate swaps and the ASB Term Fund. If the review finds ASB doesn't have reasonably appropriate processes, it can make recommendations the bank has to adopt by December 18. The reviewer is also allowed to make non-binding recommendations if it wishes. FMA General Counsel Liam Mason said in a statement, "The settlement recognises our concerns about the imbalance of information that can exist between customers and financial service providers. The review will also help to ensure robust sales and advice processes, including the disclosure of all relevant information, and that they meet the standards of the new regulatory framework." The Commerce Commission investigation into the sale of the swaps led to settlements with ASB, ANZ Bank New Zealand and Westpac New Zealand, totalling compensation payments of $24.2 million. To our dollar, the New Zealand dollar fell against the euro on optimism ahead of key meetings today that Greece may reach a deal with its creditors. The Kiwi touched 60.56 euro this morning, close to its 15-month low of 60.54 cents last Thursday, and was trading at 60.59 cents at 8 this morning. The local currency slipped to 68.97 US from 69.08 as well this morning. At the weekend, the Greek government was preparing new proposals for reforms in a bid to prevent default in a €1.6 billion loan from the International Monetary Fund due at the end of this month. The proposals boosted optimism about the country's willingness to make concessions. Greek Prime Minister Alexis Tsipras is scheduled to meet the country's key international lenders today ahead of a meeting with the leaders of Eurozone nations as part of an emergency summit in Brussels as they seek to break a deadlock over the debt crisis. OMF Senior Dealer Foreign Exchange, Martin Rudding, says today is the day in Europe. The market is leaning toward the most likely scenario of a deal of some sort, although personally I don't think a deal is a great outcome, but I suppose it's slightly better than a default. The market is probably overreacting to something that's slightly better than the worst scenario. It just means kicking the can down the road for a couple of years while they keep bailing out Greece. It's hard to see where it all ends. Proposed concessions include an end to early retirement next year, an increase in tax surcharges that mid- and high-income earners pay, and extra levies on businesses, according to Bloomberg. It cited a Greek government official who asked not to be named as the plans weren't finalised. Mr. Rudding says, I don't know if those sorts of concessions are enough to get some deal on the way, but it's desperate times today. The local currency market is likely to be in limbo as traders await the outcome of the latest talks tonight, although he favours selling the euro. In New Zealand, May monthly data on migration and credit card billings are scheduled for release today. So the New Zealand dollar slipped to 88.67 Australian, fell to 43.42 British pence and dropped to 84.66 yen. The TWI declined to 71.76 from 71.92 on Friday.
This is NBR Radio on Monday, June 22nd. I'm Owen Poland. Well, well-known honorary professor of agri-food at Lincoln University, Keith Woodford, says he expects the majority of the 50,000 sheep exported 2 weeks ago for a breeding program to Mexico, he expects them to be slaughtered within months of arrival. Joining me to discuss that story is Jamie Ball. Jamie, what's the basis of Professor Woodford's belief?
Yeah, good question. His contacts is the short answer. He has dealt in great depth in this area for many, many years. He has an awful lot of international contacts. When I first brought this story up with him about the shipment, he was of the opinion that it's a very significant story. And he followed that up with his statements, which I've put to MPI, and I gave them at least, I think it was 2 days. Plenty of time anyway in which they could rebut them, and quite notably they haven't rebutted them. They've clarified a few issues, but the most serious allegations have not been rebutted, which I'm very curious about, and it's important also for readers to know that this is a developing story. I have a number of more questions through to MPI and through contacts down and through the South Island, and we'll be developing this story as it progresses through the week.
Now, a key feature of Professor Woodford's thinking here is about the actual breeding of these animals and what he describes as terminal crosses. Tell me more about that.
Yeah, it sounds pretty grave, all right. Effectively what he's saying is that in his opinion, and he's not alone in this in terms of I've spoken to other people off the record, but they do not feature, of course, in the article. It is highly unusual that you would use stock like this for breeding purposes. For the most part, breeding stock are your best stock for obvious reasons, especially when you produce an entire flock or herd in Mexico for theoretically years or decades to come. You effectively don't export your runts. A 10-month-old sheep, effectively a ewe lamb, is not really where you want to go. Also, they're very, very young for breeding. Combine that with the fact that their susceptibility to disease and sickness at that age. For travelling, you're going from a New Zealand winter, and even worse, a South Island Timaru winter, to a Mexican summer, with just one vet on board with 50,000 plus animals. You really don't want to be sending over 10-month-old animals, which is what MPI have been saying. So there's a good few things that aren't quite stacking up, but we're trying to get more answers and keep an open mind as we go along. The word is across a lot of Canterbury too is that this is, and I agree with this part, a win-win for a lot of Canterbury farmers and South Island farmers because of the drought they had down there. They say a lot of the stock would have been slaughtered anyhow. Well, that's, once again, not the sort of stock you want to breed from. But having said that, their conditions down there are quite exceptional.
Now, Professor Woodward says he expects that the majority of these animals will end up being barbecued at local festivals in Mexico, but some NBR readers have responded quite forcefully to your article, demanding relevant facts and saying all this is pure speculation. What do you say to those readers?
Well, first of all, I'd say good on you. That's what we have at the comments section there for thick and for thin, for good and for worse, to actually say it as they see it. Sometimes you'll come out very favourably as a journalist and sometimes you don't. Look, all fair points, take them on the chin, but at this point in time we need to stress there's no evidence to suggest that Professor Woodward is in any way inaccurate in what he's saying. I've put the allegations to MPI, so if there was any accuracies, I think they would have ample opportunity to out that.
So far the MPI has said, the exporters have signed a statutory declaration saying to the best of their knowledge that these animals are to be used for breeding purposes, and also they've said it would be uneconomic for Mexico to import expensive breeding stock for slaughter. I mean, they're reasonable points, aren't they?
Not the economic argument necessarily. No, and Professor Woodford's talked about this a lot. We're comparing, in terms of we're looking at from a New Zealand perspective, but no, not necessarily from an economic perspective. But I have to get to the bottom of that one yet. But really, first of all, there's nothing at this point in time that can categorically prove that Professor Woodford is inaccurate, but it's not really helped by the fact of two things which MPI have never ever, since 2007, since effectively this has come into law, the live export cessation. The moratorium came in 2003, came into law though in 2007. MPI have never had any official anywhere in the world to monitor whether breeding stock was bred from or slaughtered. It has no information. Now, it has no information because the process it goes about is the people who have to make these declarations of intention, and it's just an intention. It's not a law. You're not going to be sued if it turns out the breeding stock is slaughtered. But that form is signed by exporters. Now, how can an exporter of any livestock anywhere in the world make an assertion as to the fate of that livestock when it goes thousands of miles overseas and is owned by multiple owners? Surely we should get a system where the importers have to declare this, and there is more monitoring. First of all, an MPI official on board, and possibly some sort of follow-up visit, I don't know, weeks, months later. But as Professor Woodford's pointed out in the 2007 shipment, which had 35,000 or so sheep going to Mexico, he's saying, well, where's the progeny of that? There should be hundreds of thousands of sheep bleating around Mexico of New Zealand origin. He's not aware of any, and all his Mexican contacts have never seen them.
Good point, Jamie. We look forward to further developments on this story. That's NBR reporter Jamie Ball.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
To our dollar. The New Zealand dollar may gain this week as investors who successfully shorted the currency in recent weeks bet that its decline has run out of puff in a quiet patch for local data. The Kiwi may trade between 68 and 71.2 US this week, according to 13 currency analysts surveyed by Business Desk. 6 bet the currency would gain, 4 said it may remain relatively unchanged, and 3 picked it to fall. It recently traded at 68.96 US. The local currency has shed more than 9% since the start of May as expectations mounted that the Reserve Bank would start reducing interest rates, which was confirmed when it cut the benchmark a quarter point to 3.25% on June 11. In the lead-up to the decision, speculative investors held a record level of net short positions on the Chicago Mercantile Exchange, betting the currency would fall. With little data due out to drive the Kiwi lower this week, investors who are borrowing to make bets may crystallise their profits. Bank of New Zealand currency strategist Raiko Sharif said leveraged investors will become frustrated when Kiwi stops moving to the downside. They will take their profit on their positions if it becomes clear that the Kiwi is not going to continue to fall at the rate that it has over the past month and a half. Those expecting the currency to fall cited the expectation for local interest rates to move lower, while improving data in the US supported the case for higher rates there. Migration data released this morning showed it rose to a new record in May, while credit card balances for the month will be published this afternoon. Data on high-debt mortgage lending will be published on Thursday, and merchandise trade for May due Friday. Elsewhere, Chinese manufacturing data due tomorrow is expected to show the sector remained in contraction. China is New Zealand's largest trading partner. In the US, the final reading of first quarter gross domestic product is scheduled for publication Thursday. The Federal Reserve is expected to start lifting interest rates from near zero this year, looking through weakness in the first 3 months. In Europe, traders will be keeping an eye on negotiations between Greece and its creditors as talks come to a crunch today. After months of pushing back against austerity measures, the Greek government is offering some concessions before Euro leaders are to gather in Brussels for an emergency session on the fiscal fate of the nation. Uncertainty about Greece may be reflected in Germany's IFO Business Climate Index due Wednesday. In Japan, Friday's data on May inflation will be closely watched by the Bank of Japan as it remains well below its 2% target, suggesting further easing in policy may be ahead. In People News, Pine Gold Corporation Chairman Brian Mogridge has stepped down as chairman of Australian property company Lantern Hotel Group, saying his role as a catalyst for turnaround is complete. Lantern is 34% owned by interests associated with NZX-listed Pine Gold and the Cayman Islands-registered Torchlight Private Equity Fund. His resignation comes in advance of a special shareholder meeting on Wednesday, calling for the removal of Mr Mogridge and fellow directors Russell Naylor and Deborah Cartwright. Mr Naylor is also a director of Pine Gold. The meeting was called by Australian fund manager Millennium Asset Services, which controls 24% of Lantern as trustee of the Borg Fund, an investment vehicle created by defunct investment firm Van Eyck. Millennium argues that the three directors are not independent because of their links to Torchlight and seeks their replacement with two new independent directors, John Murphy and Graham Campbell. The meeting is one facet of a complex battle involving Millennium, Lantern, Torchlight and Macquarie Bank, which had a close relationship with Van Eyck and has claimed Millennium was not properly appointed as Borg's trustee. In its announcement to the ASX last week, Lantern said Mr Mogridge will be replaced as chairman by Julian Davidson, a former chief executive of Independent Liquor. Mr Davidson also has hospitality experience as a former owner of Consolidated Hotels and Taverns, which operated 12 pubs in the Auckland area. Alongside the resignation of Mr Mogridge, Lantern announced the appointment of Shirley Liu to its board. Lantern said Ms Liu would take over as chairwoman of its audit committee from Ms Cartwright, who is incapacitated due to serious illness. According to its website, Lantern owns and operates 13 hotels in Australia, mainly in New South Wales. The business has been working on a strategy to improve the value and performance of the hotels since a restructuring in 2012. In a letter to shareholders stating his opposition to Millennium's proposals, Mr Davidson said he had been attracted to the board by the opportunity to play a role in turning around a group of very broken, dysfunctional hotels. The properties had suffered from neglect in the past, which had led them to attract a type of clientele that may inhibit future growth by making the venues unattractive to people with greater levels of disposable income. Lantern shares are currently trading around 10.5 Australian cents, up from 8 cents at the start of the year.
NBR Radio with the Property Press. It's out now to show you around.
This is NBR Radio on Monday, June 22nd. I'm Owen Poland. Warren Buffett is widely recognised as the world's canniest, if not most knowledgeable investor. He surprised the markets last week when he made his first major foray into an Australasian insurance company, IAG. In his Editor's Insight today, Neville Gibson takes a closer look at this investment. Neville, what brings Warren Buffett to this part of the world?
Well, the short answer is insurance. His company, Berkshire Hathaway, is heavily involved in insurance. In fact, it makes up about a third of the total $350 billion value of the company. So that makes it worth the insurance side of it, about $120 billion. Most of these industries are viewed as boring that Buffett likes to invest in, but it really goes to the core of his philosophy. In the deal with Insurance Australia Group, IAG, he takes 20% of the premium income, pays out 20% of the claims, and in addition is buying $500 million worth of new IAG shares, and that'll give him a 3.7% interest. It's an interesting sort of deal because effectively it's underwriting IAG and basically giving Buffett access to the future growth of that company. Some have said that it's gone and diluted the shares a little bit, but they're taking a longer view that IAG will be better off now in going into Asia, that kind of thing.
And you say taking a longer view. It's remarkable at Warren Buffett's age that he's still thinking long term.
Yeah, he certainly is. He's 84, and we can only compare him with Rupert Murdoch because, like other successful businessmen, these people, while they might stay on longer than most people would like, they actually are looking well beyond when they've left the scene. In the insurance business, getting the premium before you make the investment, then you get the profit on how well that premium's invested. So Buffett is looking out 10, 20 years. In fact, this deal runs over 20 years because while the shareholding in IAG is only 3.7, there's a plan to increase that right up to the maximum you can do so in Australia for an overseas company of 14.9%. So whether he's still around at the age of 94 when they get this full shareholding, who knows?
So what does he say about the future of his IAG investment?
Well, first of all, he gets a very good and very dominant insurance business. For example, in New Zealand alone, IAG owns NZI, State, Lumley and AMI and own just as much. They've only really got one big competitor in Australia, and that is Suncorp. As for the kind of shares he'll be looking at, it's best to just quote him saying it. He says he likes to look at businesses that we think have good long-term economics, where we think the managers and employers are both trustworthy and able, and where the money makes sense. And the same criteria, he says, they use on buying in any country around the world.
So are there other investments in this part of the world that he's looking at?
Well, not at this stage. First of all, he said that $500 million invested into IAG wasn't enough. He says, I would have liked to have committed more, but they said they'd only take $500 million. That's understandable. They didn't want it to be seen as a takeover. And they will be restricted to that 49% of foreign ownership. But IAG's capital will be able to be reduced slightly. It'll be able to build up further growth overseas. And there's no question that IAG will be looking offshore into Asia. The other insurance company, AIG, not to be confusing the two, is actually primarily based in Asia, and obviously he's looking to take on that major company as well.
So just finally, how does Buffett view his long-term prospects in this market here and in Australia?
Well, the interesting thing is he doesn't seem to be worried about price or even timing, and a lot of investors look at that sort of thing. He thinks he's getting a good investment, and he's also done the same when he bought into H.J. Heinz and Kraft just in the past few months. These are with a major hedge fund company. But people said, does he overpay? The thing is, if you pay a little too much for a very good business, he says that'll work out over time. The main thing to do is to get a decent business with decent people. Buffett is actually known for not interfering with his companies too much, and he describes insurance as our first love, our long-term love, and our future love. So that more or less sums up the fact that when he first bought into Berkshire Hathaway, it made shirts. Their first investment worth just $8 million went into an insurance operation, and now that's worth $120 million United States dollars. So that's the summary of Buffett's experience.
And I think possibly where he goes, others will follow Neville. That's Neville Gibson's Editor's Insight.
NBR Radio. With Clooney Restaurant now offering Auckland's most exclusive private dining room. NBR Radio.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. VNC Cocktails offers 3 cents in the dollar. Air New Zealand sells Safe Air Engineering. Consumer confidence drops. Migration figures continue to hit new highs as those going to Australia the smallest since 1992. Dunedin Clean Tech reaches crowdfunding goal, and A2 Milk is a takeover target. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. To the NZAX, some of the companies listed on the NZX's alternative market affected by a near 5-fold hike in annual listing fees have vowed to fight the impost. Others are talking about delisting, but because of the short notice, they won't be able to avoid this year's increase. Others feel they're over a barrel because they want to remain listed and so feel they'll just have to pay up. But NZX is now saying it's willing to be flexible depending on each company's circumstances. Last week, the day before it launched its new second board market, NXT, NZX gave NZAX-listed companies with less than $15 million market capitalisation less than 2 weeks' notice that their annual listing fees are rising nearly fivefold. The 13 companies affected, some already struggling to survive, will see their annual fee rise from $5,375 to $25,000 from July 1. Chatham Rock Phosphate Managing Director Chris Castle says we're going to be reacting. He says it's a bit over the top. They're obviously trying to drive us out of that market. We're not going to take it lying down, but I'm fighting everybody at the moment. A year ago, Chatham Rock wouldn't be affected, but it reported a $27.3 million net loss for the year ended March after its marine consent application to mine Chatham Rise off the Canterbury coast was declined. The company has dramatically scaled back its operations with a view to reapplying for marine consent sometime in the future and is exploring other ventures. Mr. Castle says he had been expecting a significant drop in listing fees. Chatham Rock's market capitalisation on Friday was $2.3 million. Enprise, with a market capitalisation of $3.4 million, only listed on NZAX last December. Chief Executive Mark Lovey says his company has just shifted from Australia's NSX market, which, like the NZAX, is designed for small companies because it's New Zealand-based and wanted to make it easier for New Zealanders to invest in it. Mr. Lovey says the costs of each exchange was previously comparable for his company, which has developed cloud billing and customer self-service technology. While NZX is encouraging NZAX companies to switch to the NXT market, the minimum market capitalisation for NXT is $10 million, which means Enprise is too small. Mr. Lovey says he doesn't feel Enprise has any option other than to pay up. He says, I don't think we have any other option at this point. We don't want to delist. But he's annoyed at both the extent of the fee increase and the short notice. Mr. Lovey says we could never do that to our customers, but then we work in a competitive field. It just shows NZX is a monopoly. He notes Australia's NSX market is completely independent of the main ASX market. Just Water International chairman and major shareholder Tony Falkenstein, who's already publicly described the fee increase as an abuse of monopoly powers, will be meeting NZX officials this week. To cyber attacks. Companies are afraid to speak out about cyber attacks for fear it looks incompetent or an easy target, according to the head of Institute of Directors. IOD Chief Executive Simon Arcus told NBR Radio the Institute increasingly hears anecdotal reports of hacking and cyber breaches, yet businesses are not publicly admitting they've become a target. He says we are aware of cyber breaches going on, but the problem is businesses are unsure of what to do and are reluctant to stick their head above the parapet. And there's good reason for that. They're concerned they look like an easy target or that they've failed in some way. He says, but the flip side is it's harder to come to a solution without knowing the extent of the problem. It's a catch-22, if you like. But by not speaking up, businesses are becoming more vulnerable. Mr. Arcus says to protect a business of any size against the significant financial, competitive and reputational damage which can come after a cyber attack, directors need to understand and monitor the risk better. He says cyber risk is not just an IT issue anymore, and directors need to be aware of that. It's no longer about having a good firewall or penetration testing. It's an enterprise-wide issue. It relates to staff, processes, customers, insurers and regulators. It's about understanding what the critical infrastructure is. Mr. Arcus thinks a law firm would be a good business to hack because of the huge amount of concentrated confidential and individual-related data it holds. He says, but we don't often ask how safe a law firm's cybersecurity is. We've got to take some of the fear and worry out of the discussions, and businesses have to start making decisions while being focused on the problems. KPMG, which has just finished assessing the security of about 200 New Zealand companies, says while some cyber risk comes from expert hacking, it also comes through staff daily technology use, security breaches and human error. KPMG cybersecurity leader Philip Whitmore says we pretended to be a disgruntled employee and 100% of the time we could breach security, and that was using the same techniques that most employees could readily learn. Mobile devices such as smartphones and tablets were easily breached too, he says, with unauthorized access being gained 62% of the time. A smartphone or a tablet is a computer with the same risks and weaknesses, but people don't treat them as such. Organisations don't have a good understanding of where their risks are, so they're not focusing efforts in the right direction. The Institute is launching a new course and practice guide to help boards understand and monitor cyber risk.
This is NBR Radio on Monday, June 22nd. I'm Owen Poland. Well, like many people, I'm really looking forward to the second series of True Detective, which starts on Sky TV tonight. Joining me to discuss is technology editor Chris Keel. Chris, what's so significant about True Detective from Sky's perspective?
It's going to be the second HBO series which they fast-track. With Game of Thrones, they went all out. They quite surprised me with how front foot they were. They simulcast it, so as soon as people were seeing it on Sunday night in New York, which was 1 o'clock Monday morning here, we were seeing it exactly the same time. Then they showed it on Soho at 8:30, and at the same time they put it on Neon, their $20 a month Netflix clone. And they're going to take a very similar tack with True Detective Series 2. There isn't the same global simulcast that they can piggyback on, but they're going to hustle it onto Soho as soon as they can at 4:30 p.m. today, which should be Monday, we're speaking, which should be fast enough to beat BitTorrent and other pirate services.
So what's so significant about this immediacy? I mean, I guess there's an appetite from a consumer perspective. They want it and they want it now, but from a business perspective, it's about getting ahead of the competition.
It is. I think John Follett, who runs Sky TV, to an extent he's had golden handcuffs. Sky has just made money hand over fist from the old satellite TV model. He's also become keenly aware that there's a whole generation of viewers that they're missing out of, or that sort of implies younger generation, actually, a lot of older people too, who all they're doing now is watching shows on demand, so they figure it's better for Sky TV to cannibalise its own with Neon than for people to stray to Netflix or just other alternatives for grabbing content online.
So tell me a bit more about Neon. What sort of uptake are they getting there, and are the consumers happy about that platform?
At the moment, none of the players are revealing numbers about uptake. We asked Sky today if they would say how many streams Game of Thrones got through Neon. They wouldn't, and Spark has been quite cagey with Lightbox as well, and Netflix hasn't broken out any figures for New Zealand yet. But what we do know is that Chorus, which runs the wholesale network, which most of us use in our home connections, it's saying there's a 40% increase in traffic between February and April. That's the launch of Lightbox, Neon and Netflix New Zealand. So we know that a whole bunch of people are taking up this new viewing option.
What about from a quality perspective? Are people happy with what they're getting through the likes of Neon?
Yeah, we have had a few grizzles there. I've said, hey, that there's no excuse for piracy now, and some people have been very picky are saying, but Neon is standard definition, whereas most of the other services are high definition, and Netflix even has something called ultra high definition, which will demolish your data cap very quickly. So there is still that, but Sky has heard that criticism, and they say they will introduce a high def or HD option for Neon, though they haven't put a timeline on that yet so far.
And what about from the profit and loss balance sheet perspective of Sky? Is there any sort of noticeable financial benefit in it pursuing this immediate path to viewers' hearts and minds?
Well, I think long term, there's two things they can do. One is tying up content, so they've signed all these 5-year deals from HBO and Disney to sport. And the other thing is they just have to start offering these online options, and it is a case of hoping that it pays off down the track. Will it ever be as profitable? I'm not sure. I've just had John Follett, the Sky CEO, recently warning that dividends won't increase in the near future, and the company might have to borrow to keep dividends at its current rate. So Sky TV shareholders are going to be keeping a very close eye on the situation.
All right, thanks, Chris. That's technology editor Chris Keel.
NBR Radio. Free to air online with business news you can use.
Let's talk sheepskin exports. New Zealand exports of sheepskin and lambskin at their lowest level in more than 4 years are unlikely to recover anytime soon as a glut of excess stock and weak demand weigh on prices. According to Stats New Zealand data, the value of raw sheepskin and lambskin exports fell to $128.6 million in the year through April, the 15th straight decline in annual exports and the lowest level since January 2011. The latest figures for May will be published on Friday. The market for skins has slumped after tougher environmental regulations led to the shutdown in April 2014 of many tanneries in China, where New Zealand sells as much as 60% of its lambskins. Weaker consumer spending in China and trade sanctions on Russia also hurt demand in key leather markets. Rachel Agnew, an agricultural analyst at AgriHQ's iFarm, said, while the tanneries are starting to get back into action now, there are still huge amounts of product that's sitting there trying to get through the works. You're talking about an oversupply of products still waiting to be processed that no one really wants on the global market. The price for lambskins has halved from the start of last year to about US $50 a dozen from US $95 a dozen. Compounding the problem further, New Zealand had a higher than normal lamb slaughter at the tail end of the season, leaving processors with even more skins. Many farmers had held on to their lambs for longer in anticipation processors would raise prices near the end of the season as they traditionally compete for supply to fill orders. However, weak global demand kept a lid on prices and farmers were forced to offload their stock as pasture growth slowed heading into winter. Ms. Agnew said, we've never seen a year where prices didn't increase from about mid-May, but this year we're perhaps even looking at some decreases in schedules, which is pretty scary for some sheep farmers. They have no choice but to get rid of them, and so they've just pressed the offload button and they're all hitting the works all at the same time. So it's a bit of a lose-lose situation, you could say, because the processors don't really want them and farmers aren't really making any money from them. Global markets for lamb are very, very depressed at the moment, and so no company actually wants to pay any more for the lamb. Ms. Agnew said lamb inventories are high following a record Australian slaughter and after a mild winter boosted UK production, while demand remains weak. She said some processors are holding on to the skins, waiting for prices to recover, while others are selling at lower prices. She said it won't help that New Zealand is going to have a little bit of extra product to try to get rid of as well as what they have in inventories. Because there's so much raw product waiting to be processed in New Zealand companies are trying to get rid of the stock at lower prices, so that's not helping that price either. To the Christchurch rebuild, further evidence the government's Central Christchurch rebuild blueprint is in tatters has come with more doubt cast on anchor projects. Canterbury Earthquake Recovery Minister Jerry Brownlee told Parliament's Finance and Expenditure Committee hearing that completion of a convention centre wouldn't occur before 2018. He also poured doubt on a promised centrally located Metro Sports Centre, suggesting if it were built, it would be a far less grandiose facility than the one envisaged by Sarah's blueprint architect Don Miskell. Mr Brownlee also says there is a problem with asbestos on the site. Prime Minister John Key announced the rebuild blueprint in 2012 in a stage-managed civic announcement. Under the plan, the convention centre would be paid entirely by government at cost of $284 million, and the Metro Sports Centre would cost $217 million, with the government contributing $70 million, which includes the land it owns. Efforts to obtain more information by NBR and other media have repeatedly been stonewalled by Mr Brownlee and Sarah. Mr Brownlee's raised doubts about the facilities as Sarah is due to enter a transition phase with its responsibilities handed to other agencies or the City Council. A report is due out about how this will happen. Business leaders are increasingly questioning Sarah's relevance. The agency arguably played an important part in requiring owners clear the city of derelict buildings and acquiring commercial property and giving landowners compensation. But its shortcomings in rebuilding are evident to any visitor as the private sector races ahead with a massive building effort, leaving the Sarah-controlled areas still looking like a wasteland. Crown-sponsored projects are so far restricted to about 4 buildings, a newly opened and partly government-funded bus exchange, 2 emergency services and justice buildings, and a hospital rebuilding program underway at Burwood and beginning at the hospital in Central Christchurch. The hospital program was on the books before the earthquakes. Sarah is pressing ahead with a controversial playground alongside the Avon River and a plan to make Manchester Street a slow-speed boulevard, which requires destruction of the new West End building over the next fortnight. The West End building was the first to be rebuilt after the 2011 earthquakes and an early symbol of the rebuild. Its removal will allow road widening, allowing residents and cyclists more priority. Meanwhile, Christchurch City Council is partway through a fast-track process to prepare a new district plan for all of Christchurch and Banks Peninsula. Stage 1 of the process was notified in August 2014 and the hearings are partway through, with some initial decisions released earlier this year. Stage 2 has recently been notified and covers rural and hill zoning, specific purpose zones for particular activities, and rezoning some additional greenfield land for residential and industrial use. It also includes general rules that apply throughout Christchurch, covering matters such as noise, signage, temporary activities and water body margins. Submissions on Stage 2 closed on June 15. The Council will release a summary of submissions on June 29 with the opportunity to lodge further submissions until July 13. And Stage 3 is the final stage of the proposed plan and due to be notified on June 27, with submissions on Stage 3 open until August 7.
This is NBR Radio on Monday, June 22nd. I'm Owen Poland. Well, the Greek debt crisis seems to finally be coming to a head. Last week we heard about a run on the banks ahead of a crucial EU meeting this week. Joining me now is reporter Jason Walls. Jason, what's the latest in Europe regarding the Greek saga?
Well, they've got their big meeting tomorrow between Alex Tsipras, who's the Prime Minister, and their creditors. And just a little bit of background first, they've got the payment to the IMF, which is looking to be paid at the end of June, because you'll remember we've talked about in the past, they consolidated all the debt that was supposed to be paid a couple of times in June into one payment in a bundle at the end. It's very widely understood that the Greeks have no money to pay for this. And the only way that they'll be able to pay the IMF and some of their other creditors is actually by unlocking more bailout money from the same creditors that they owe money from. So it's sort of like a bit of a cycle here. Hopefully smarter people than I do know what's going on in that, how the credit stuff is going to be working in the future. But for now, let's just focus on the news. So, yeah, as I said, they've got no money left. And basically what the European Central Bank, the IMF, the other creditors have been reiterating from the start is that there needs to be austerity measures in place for Greece to be able to get more money. There was an analogy I used a few weeks ago that said if people are paying you money and they're telling you that you need to cut back on a few things, it's probably important to do so. However, if you've got people in your household that are saying, actually, we want this, and they can't actually tell us what to do, it gets a little bit difficult. And that's what we've been seeing that's been happening in Greece the last week, is there have been a lot of protests and people camped outside the government saying, you need to fight the creditors, you need to fight these people to say Greece will stand up to them, and et cetera, things like that. And so they're very staunchly against making these austerity measures. And I think the general attitude is that they want to see who flinches first. And they want to say, if we stand our ground, then nothing will get passed, and we can actually keep going the same way that we have in the past, and we don't have to change that much. Obviously, the government will be looking to make some changes, and it's worth noting that they have, but nothing that they've done so far, or very few things that they've done, have been substantial enough for the creditors, for example, Christine Lagarde, to say, good, this is what we want. They've said it's a good start, but we need more, and there's been this constant back and forth between the two. What we did see just a few hours ago is that Tsipras released a statement on his website saying that he's actually made proposals and he sent those through to the creditors. So it's now a waiting game to see what happens next. Are those proposals going to be accepted? Are they going to be torn to pieces and say you need to come back, or are they going to throw the book at them? It's yet to be seen.
I see one of the headlines coming out of Europe in the last hour or two says Greeks beg Angela Merkel, Germany's Angela Merkel, not to throw them overboard as the day of reckoning approaches.
That is very sensationalised. Yeah, it's quite an image, isn't it?
Yeah, what's the concern from the rest of Europe's perspective?
Well, it's sort of something that it's been mentioned quite a few times, is this idea of the domino effect. So essentially you've got Greece that aren't obeying these instructions from their creditors, and they keep saying, we're not going to give you more money unless you make reforms. And then Greece don't make the reforms, and then they get money anyway. So that kind of leaves you scratching your head. And a lot of the other European countries, because there are a few, you'll know the pigs countries, Portugal, Ireland, Germany, or Greece, sorry, not Germany, and Spain, who are quite heavily indebted as well. And basically one of the big problems is they're saying, if they can do this, why can't we? So instead of them imposing austerity measures when the time comes, essentially, if they need to start repaying some of their creditors, they could turn around and say, hang on a second, Greece have basically just walked all over you because they say that without us, the euro is going to fail. And it was something that the interesting character of their finance minister said over the weekend, he said Germany needs to choose between a more lenient terms for Greece and destabilizing the Eurozone. So it almost sounds like an ultimatum. And he's holding this entire continent hostage because he's got this way of thinking that if you let us go, it's going to be worse for you. So it's a dangerous way of thinking, and that's a real problem for the other European countries in the future. And also, if you think about it, I mean, I've made this point before, but it's something that I really feel quite strongly about, is that you've got these poor countries in South America and Africa that have been struggling for so long, and they haven't been able to get a lot of the assistance that countries such as Greece have from the IMF. And now they're turning around and looking at this situation and saying, hang on a second, how is this fair? We've got people literally dying of hunger and bad sanitation and things like that. But yet we're not getting the funds that we should rightly be getting. But they are, basically, because they're making these sort of, I'm not going to call them empty threats, but they're making the sort of this big song and dance about it. So it's yeah, I mean, there's more to come, and we'll be talking about it a few more times, which I'm sure you'll be very happy about.
Yeah. Well, hopefully, we might get something solid in the next 48 hours, Jason, but I won't be holding my breath on that one.
Yeah.
Thanks, that's Jason Walls.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
To the Chinese market, a business owner says small food exporting businesses are being sidelined from the Chinese market because of high regulation costs. Southern-based food exporter Quality Food Southern Chief Executive Cameron Scott says because of the high cost of implementing a risk management program, or RMP, many small food-producing businesses don't have the opportunity to crack the Chinese market. Mr. Scott says his business spent $500,000 upgrading its plant to the standards needed to receive an RMP. He says high costs like these impose additional overheads on small businesses, forcing them to keep out of the Chinese market. For a food company to export to China, an RMP, which is a set of regulations designed to manage hazards for some foods, is needed. An RMP sets out how the operator identifies and controls, manages, eliminates or minimises food safety hazards and other risk factors in processing. Although Mr. Scott says ultimately having higher food standards is good, many smaller businesses looking to export their products to China will struggle to find the capital to comply with the regulations. Lincoln University Agribusiness Management lecturer Dr. Nick Lees says there has been a shift from within China to tidy up its food regulations. He said they're trying to get more control over their food systems, both export-wise and within the country. He says having to comply with these regulations has been an impediment for smaller business and makes it difficult for some of the small players to remain competitive with the bigger guys. As well as this, he says some of the bigger Chinese companies and its government don't want to deal with the smaller businesses exporting into China. Dr. Lee says this is advantageous to some of the bigger companies with scale that can afford to comply with the regulations. But the smaller companies will find it hard to pay the costs and can easily become locked out of the Chinese market. Export New Zealand Executive Director Catherine Baird says although the regulations can be challenging for small businesses and could possibly be putting some off, businesses don't need to rush China unnecessarily. She said SMEs need to think about how many customers they need and the degree of difficulty in where they choose to go. She says importing into China is not for the faint-hearted, as dealing with the bureaucratic process can often be a struggle for smaller businesses. Let's talk NZX. A hefty price rise for NZX index data has vexed some financial institutions as the exchange moves to a new regime for its index products. In February, the NZX announced it had entered a strategic agreement with S&P Dow Jones Indices in which the two parties would collaborate on the development and commercialisation of the New Zealand index business. From June 21, S&P DJI will start calculating, publishing and disseminating the NZX indices, as well as their distribution and marketing in overseas markets. Amid the management changes, some institutions say they're being asked to pay as much as 5 times more for index data feeds they require for their businesses. Although the fees don't look large in the context of a fund management business, the new cost can be around $15,000 US for one index feed. The increase has prompted grumbles among some market players, although none wanted to talk openly about the matter. One said it's predatory behaviour of a monopolist. An alternative view was offered by another who said the important thing was to get an index that was independent and accurate. He said it's a price increase, but maybe we're now paying what we should have been paying before. A spokesman for the NZX said some data clients had previously received discounts which would no longer be provided under the S&P deal. He said data clients will benefit from regular market communication from S&P on index changes, standardised data forms now matching formats received for the Australian market, and more globally aligned indices methodologies that will make market monitoring and data usage more efficient for end users. A spokesman for S&P said the firm couldn't comment on the new pricing strategy, but said, "We can confirm that we're standardising our data offering for NZX S&P index products. Under the new arrangement, clients will be able to access a consolidated data package that features a full set of data including daily data feeds, index weights, upcoming index changes, index levels, corporate actions, etc." Meanwhile, changes to the NZX Portfolio Index have led analysts at Forsyth Barr to label it an entirely new index. In a research note dated June 17, Matthew Leach and John Hughes said a new approach by S&P had generated significant re-weighting of stocks on the index. They said the change in approach and methodology, in our opinion, results in a new index. We do not believe this benchmark index with such revised methodology can be strictly compared with the historic values of the existing NZX 50 Portfolio Index. Indexes are used by active fund managers as a benchmark for their portfolios, while passive fund managers match their portfolio holdings to their chosen index. For example, the NZX SmartShares NZ Top 50 Fund is a passive exchange-traded fund which tracks the NZX 50 Portfolio Index. Changes to the index will trigger matching purchases and sales by the fund. In market news, A2 Milk Company, the dual-listed milk marketing company, has received an expression of interest from two associated trade parties keen on taking over the company, which may force the firm to shelve a planned capital raising. The shares jumped to an 11-month high. The parties have requested confidentiality and warned their expression of interest could be withdrawn if their names become public, A2 Milk said in a statement. The shares climbed 23% to 70 cents, the highest level since July last year. The proposal is subject to a number of conditions, including due diligence, exclusivity, no material adverse change in the company's affairs, New Zealand Overseas Investment Office approval, and no change in the number of shares on issue. The company said the last condition is particularly relevant as the company was well advanced in planning for an equity raising. A2 Milk's board is seeking further information to evaluate the proposal before updating the market and said no further comment would be made at this time. The single biggest shareholder in the company is Australian-based Freedom Food Group with 19.14%. It increased its stake this month. First New Zealand Capital and Milford Asset Management also both gave notice of substantial shareholdings this month. When A2 Milk listed on the ASX earlier this year, it didn't include a capital raising, despite a launch into the US market with fresh milk, which is budgeted to cost around $20 million US over the next 3 years. Earlier this month, A2 Milk said it was suing the Australian Broadcasting Corporation, alleging misleading and deceptive statements in advertising its consumer affairs program, The Checkout. A2 Milk's Australian subsidiary has lodged actions in the federal court in Sydney after the public broadcaster promoted a segment that called the company's scientific claims bogus. A2 Milk claims this was a breach of the Competition and Consumer Act. ABC rejected the suggestion that the matters A2 Milk had complained about involved misleading or deceptive conduct. The company markets its products as potentially being beneficial for people who suffer intolerance to the naturally occurring A1 protein in milk, including bloating and stomach pain. A2 Milk has captured some 9.3% of the Australian fresh milk market by selling milk that only has A2 protein. The stock debuted on the ASX at 55.5 Australian cents and recently traded at 51.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
And now a Safe Air update. Air New Zealand said it wasn't expecting any job losses as a result of the sale of its Safe Air engineering subsidiary to European aerospace giant Airbus Group. In a statement, the national carrier said it had signed a conditional agreement to sell the wholly owned subsidiary to Airbus Group Australia Pacific, which is a major supplier to the Australian Defence Forces and civil helicopter retailer. The value of the deal, which is expected to be completed next month, is being kept confidential. Air New Zealand didn't advise the NZX or ASX about the sale, typically a sign that it doesn't meet the stock exchange's test for material information. Safe Air does upgrade and maintenance work by the Royal New Zealand Air Force and other military and commercial aircraft operators around the world. It has 190 employees across its main facility in Blenheim and its air bases in Ohakia, Whenuapai and Moorabbin in Melbourne, Australia. Air New Zealand has been exploring opportunities for some time to sell the business, which was regarded as non-core. Chief Operations Officer Bruce Parton said the company's history with Safe Air spanned more than 4 decades and it was important that its future success was ensured. He said Airbus Group is highly regarded in the aviation industry and as a world-class military service provider is closely aligned with the services Safe Air undertakes. Airbus Group Australia Pacific employs more than 1,400 staff at 15 sites across Australia and New Zealand. Jens Goleman, Managing Director of Airbus Australia Pacific, said Safe Air's reputation, skill set and outlook are all strong and closely aligned with Airbus Group. We've worked with Safe Air in the past and for us bringing the company into Airbus strengthens our position and potential in New Zealand. Air New Zealand shares rose 0.4% to $2.50. To consumer confidence, yes, New Zealand consumer confidence fell in the second quarter to its lowest level in more than 2 years, as declining dairy prices weighed on optimism over the economy's outlook. The Westpac McDermott Miller Consumer Confidence Index fell to 113 in the 3 months ending June 30 from 117.4 in the March quarter and is at its lowest level since March 2013. An index reading above 100 indicates optimists outnumber pessimists and the historical average is 111.5. Consumers were more optimistic about present conditions, with the measure rising 1.9 points to 115.1. They were more pessimistic about the future, with the expected conditions index dropping 8.5 points to 111.6, below the historical average of 113.6. The survey comes after dairy prices last week fell to their lowest level in 6 years at the GDT auction. Earlier this month, the Reserve Bank cut the official cash rate 25 basis points to 3.25%, with Governor Graham Wheeler citing the slump in global dairy prices and its impact on the nation's terms of trade as weighing on the economic outlook. The Reserve Bank estimates a quarter of dairy farmers are operating in negative cash flow. Westpac New Zealand Chief Economist Dominic Stevens said the drop in consumer confidence isn't surprising, given the steady drumbeat of bad news around the dairy sector. The reality of a lower dairy payout is only starting to hit farmers' cash flows, and the recent drop in the exchange rate will result in a range of imported goods becoming more expensive. We wouldn't be surprised to see confidence fall further from here, though lower mortgage rates will provide relief for borrowers. The decreasing optimism was reported in both rural and urban sectors, the report showed. The biggest change was respondents' expectations for the near-term economic outlook, with a net 4.8% now expecting mainly good economic times for the year ahead, down from 23.8% 3 months ago. The net percentage expecting mainly good economic times over the next 5 years fell to 24.3% from 26.8%, while the net percentage expecting their own finances to improve over the year slipped to 5.9% from 9.8%. Respondents were more optimistic on current conditions than 3 months ago. A net 1.4% said their financial situation had improved over the past year, from a net 1.4% saying their situation had deteriorated. A net 28.8% said it was a good time to buy a major household item, compared to 27.8% in the March quarter. The survey ran between June 2 and 13 with a sample size of 1,581. To migration. New Zealand annual migration rose to a fresh record in May as fewer locals left for Australia, while more returned from across the Tasman and more students from India and China arrived. Statistics New Zealand said the country reported a net gain of 57,800 migrants in the year through May, ahead of a 36,400 gain in the year earlier period, and the 10th consecutive month where migration has broken records. Migrant arrivals rose 15% from the year earlier, while departures slipped 10%. New Zealand's annual net migration already beat the Treasury's forecast peak of 56,600 and is closing in on the 60,000 figure used for the basis of the budget's economic upside scenario. Under that framework, the Treasury expected faster growth over the next 2 years, as new migrants would fuel consumer spending before putting more pressure on the housing market. ASB senior economist Chris Tennant-Brown said in a note, "We expect that the population will continue to be boosted by net monthly migration inflows around current levels for at least the next 6 months, which would see annual migration inflows peak around 58,000 in mid-2015. The risk is this level of inflow remains elevated for longer than we currently forecast." New Zealand's inward migration has been boosted by fewer locals leaving for Australia and more returning as the mining boom across the Tasman slows and the sharp drop in the global price of iron ore weighs on Australia's economic prospects. Today's figures show the smallest annual net outflow to Australia since 1992, with a net loss of 1,400 people leaving to Australia in the year ended May 31st, down from 9,700 last year and 32,900 in 2013, according to Stats New Zealand. On a monthly basis, New Zealand had a net inflow of 533 migrants from Australia in May, extending the gain from April, which was the first time New Zealand reported a monthly gain from across the Tasman since 1991. Record inbound migration has been bolstered by an increase in international students led by Indian and Chinese arrivals. Indian arrivals doubled to a net gain of 12,100 on an annual basis, from 6,585 arrivals a year earlier to be the biggest group, while the number of people arriving from China increased 22% to a net gain of 7,745. Arrivals from the Philippines increased 49% for a net gain of 4,192 people to be the fourth largest source of migration, just behind the UK, which showed a net gain of 4,473 people, declining from the previous year's net gain of 5,719. Separately, the number of short-term visitors to New Zealand rose 10% to 176,700 in May compared to the year earlier, as Chinese short-term visitors were at a record level for a May month. Population Stats Manager Vina Cullum said the number of visitors from China increased 45% in May 2015 compared with 2014. Most of this increase was from Chinese holidaymakers. On an annual basis, visitor arrivals increased 7% to 2.98 million, led by more arrivals from China.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebret.com. NBR Radio.
In media news, speculation that Heather Duplessis-Allen and Duncan Garner are poised to take over the TV3 Monday to Thursday 7pm current affairs slot has the stamp of approval of leading media commentators. On the weekend, it was reported that Ms Duplessis-Allen is in a bidding war between TV1 and TV3. She's currently a political reporter for One News and an interviewer for TVNZ's Q&A program. Meanwhile, Mr Garner already hosts other MediaWorks shows, 3D on Sunday nights and Radio Live's weekday afternoon program Drive. Media commentators say both are hard news journalists, so the show would be slightly more serious than TV1's 7 Sharp. In a press release announcing the end of Campbell Live, MediaWorks head of news Mark Jennings said the new show will have a wider mix of stories. However, he told Radio New Zealand in May the new show won't be light and fluffy, but that doesn't mean to say it won't be entertaining, and some of its stories will be lighter. But we are not, he said, in any shape or form abandoning good sound journalism. JD Media Director John Dee says the public's reaction to Campbell Live's demise has forced MediaWorks to rethink what sort of personalities and format the new show will have. He says they can't afford to be too fluffy. However, media commentator Martin Gilman says while the show will be more serious than 7 Sharp, it will still have the magazine-style BuzzFeed-type content we're all heading toward. But he says the elephant in the room is how 3 News is performing. He said it's not that the news has a serious problem because it's not that different from One News, but it's just not performing. 7pm needs a good lead-in. Losing home and away at 5:30 lost 3 News some of its audience, he says, but that's only a part of the problem. He speculates viewers may be boycotting TV3 after the Campbell Live debacle, but says that's unlikely. Media commentator Brian Edwards says both a highly respected journalist and Mr Garner successfully combine strength and forcefulness without being rude. Mr Edwards adds that 3D hosts Mr Garner and Samantha Hayes do not have the right chemistry. Mr Garner and Ms Duplessis-Allen would be entirely different, he says. He went on, I'm guessing there would be incredible mutual respect between the two. The problem with 3D is there is no rationale for having those two people there. Obviously, Duncan is the stronger of the two. The conversation is so stilted and fake, they have their lines and are reading off an auto cue. In crowdfunding news, Dunedin-based clean tech startup Powerhouse Wind has equity crowdfunded $409,000 from 79 investors on the Pledge Me platform reaching its minimum goal with 3 days left to go. The company says it has the potential to become the only producer of domestic-scale wind turbines in New Zealand if it can successfully implement its production strategy. The patented Thin Air 102 product, 12 metres tall with a single blade, is a 2 kilowatt wind turbine to use along with solar panels on lifestyle blocks and rural land. The initial working prototype has been operated and tested since 2008, with 12 field trials completed and turbines involved sold to customers. Powerhouse Wind Director Bill Curry says the company will now be able to commercialise the company by bringing on technical and sales expertise. He says after 5 years of R&D, we're glad we're going to be able to move into the next phase of our strategy, thanks to the support of our new shareholders. Mr Curry, along with co-founders Wayne O'Hara, Richard Butler and Peter Shaw, are former product developers and engineers at Fisher & Paykel. They envisage their turbine will become a common energy-generating appliance similar to other domestic appliances or home heating systems, and say they have engineered the turbine to perform reliably and quietly even in high wind. The campaign is capped at $900,000 for 27% of the company. The minimum investment is $1,154 at $5.77 a share, valuing the company at $2.4 million. Powerhouse Wind has pledged me's third successful equity raise in the past 10 days, with Sorbet and Angel Food also surpassing minimum funding goals. To VNC. Shake and Pour Drinks maker VNC Cocktails owner Shane McKillen has offered his many creditors a 3 cents in the dollar deal, but one creditor has claimed in court it would rather see him investigated by the official assignee and bankrupted. VNC Cocktails, started in August 2007 by 42 below founding shareholder Mr McKillen, went into voluntary administration on June 30, then was pushed into receivership by secured charge holder BNZ on July 1st after shareholders refused to postpone a debt-owing date. The company had been struggling for breath for some time due to poor distribution, but was effectively strangled after shareholder Audrey Investments, owned by prominent fund manager Warren Coolio, refused to allow a 6-month extension on redeemable preference shares due to be repaid a year ago. The High Court of Auckland heard this morning Mr McKillen has offered to pay 7 VNC creditors with claims of about $27 million, $300,000 over 2 years or 3 cents in the dollar. The majority of creditors have agreed, but Audrey Investments has not. Associate Judge Jeremy Doog is to hear all the substantive issues before deciding whether Mr McKillen's proposal to his creditors should go ahead and whether claims to liquidator Christopher Horton are valid. Lawyers Brett Gustafson, acting for Mr McKillen, says Mr Coolio would like to see VNC investigated by the official assignee and Mr McKillen bankrupted, because that would benefit a second case underway in which Mr Coolio and Mr McKillen are disputing $9 million between them. Mr Gustafson said if the court finds the majority of creditors agree, then the onus is on the objectors to prove why they should disadvantage the majority. If the offer is rejected and Mr McKillen bankrupted, then creditors are likely to get less than a cent in the dollar, he said. Mr Gustafson suggested a commercially prudent investor would take Mr McKillen's offer, to which Associate Judge Doog replied that a commercially prudent investor may think that with so little on offer, it might be better to see what an OA investigation shows up. But Mr Gustafson replied there was no need for an OA investigation and said there had been no wrongdoing despite the complicated trust structure Mr McKillen was using to run his business affairs. He said what we have is a very successful businessman who has structured his affairs in a way where he doesn't have personal assets. There doesn't seem to be any public interest to make Mr McKillen plead bankrupt. When Mr McKillen became aware VNC couldn't meet Audrey's redeemable preference shares, he took the sensible step and appointed administrators. The hearing continues this afternoon with Michael Robinson of Simpson Grierson acting for Audrey Investments and secured creditor BNZ represented by Aaron Harlow. VNC had 12 shareholders. The majority owner with 36.5% shares was Mr McKillen's company Collinsville, which was put into liquidation by the High Court of Hamilton in October. Collins Asset Management owns 26.9% and Mr McKillen owned 14.8%. Collins Asset Management is directed by Timothy Cook, who resigned as a director of VNC Cocktails on June 27 last year. Mr Coolio and outgoing Veritas Investments chairman Mark Darrow ceased being directors of VNC in May and June last year, respectively. VNC's intellectual property, manufacturing equipment and leftover stock was sold to an unknown buyer for just under $408,000 in November.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.